Hey, good morning. Let me get the poll going. Just gonna mix it up, see what you're into today. By the way, YouTube algorithm, this music is royalty free. Hey, Bernd is back in the room. Good morning again, Bernd. Oh my goodness, I need more coffee. Yeah, I'm going to need to get the coffee on. I can't imagine. Amazing. I'm out. 5 Nespresso pods gone. It's not even 8:30 in the morning. Ready? You got a few people in the room? Guten Morgen. No, I got it burnt. I was away. I was doing nonprofit work all weekend. Got home Sunday night. All right. Start in a second. All right. I think we can get going now. Let's see. Please answer the poll. Not quite enough votes to get going. I got that one also, Darko. I didn't read the attachment. Yeah. Yeah, I'm really short on time the next couple of weeks. I have more projects than I can handle. And I might be managing an endowment for a nonprofit organization, so I got that going as well. Like, I gotta say no somewhere, right? Yeah, I'll try that. All right, let's get going. We need one more vote, if that's okay. Yeah, I'm killing the music. All right, so let's get on with it. Good morning. Welcome to Forex.Today, the YouTube community of more than 20,000 foreign exchange traders. We gather here today, conduct technical and fundamental analysis with the overriding goal of planning our trades in advance because trading is risky, not appropriate for everyone. Your past performance, good or bad, is not necessarily indicative of future results. But please stay small, stay humble, focus on the long term, never risk money you cannot afford to lose. So good morning, my name is Wayne. I'm a currency trader just like you. Woo, that is hot. That bone marrow in my coffee is really something, huh? So anyways, good morning. Good to see you. Hey, we got a trading week ahead of us. Lots of interesting things going on. We have earnings season is well on its way now. And at the same time, we have geopolitical risk. So holy smokes, eh? Challenging. So luckily, we have each other in this wonderful community we call Forex.Today. So if you are new, please subscribe. So we got a lot of news. Some of the news actually has to do with China. Lots of news there, both like the potential for default, but then also there's like, I think, trade balance and an interest rate decision and a bunch of other things. So, and those are, you know, we're very in tune to what's going on in the UK and in Europe and the United States and Canada and Australia. Sometimes we miss that, right? So we miss sort of the Asian session. Another thing that you might want to look into is that New Zealand had an election over the weekend and has a new prime minister. Okay. And of course, Australia has a new head of their central bank. So lots of gobbledygook going on. Lots of things that we need to stay in tuned to. So anyways, let me know how it can help. I have a macroeconomics degree from a private institution that I will leave nameless. Wowzer, that is hot. Sorry, I'm trying to get that down. Whoa, that's hot stuff. So anyways, cool. So yeah, I know a little bit about economics. I've been a trader for over 20 years, and before that, I was a venture capitalist. Before that, I was a high-tech entrepreneur in the Silicon Valley. Before that, I worked in the nonprofit world, and from 91 to about 1995, and I just gathered with that group again, so I'm still involved And what a humbling experience to go back to that leadership organization. Now, I've stayed in tune over the years, but this is, this was an opportunity to gather with, people with silver hair like mine that were super cool in the 90s. So I gathered with a few hundred people, and I was the least interesting person in the room, and it was humbling because these guys were so amazing and so successful and so driven still in these years. And they're so humble and so generous. And I'm like, oh my God, how did I get into the room? So anyways, wow, what an amazing experience. But I bring that experience with me. Yeah, I bring that experience with me. And the goal for us as a community is to share all these experiences we have in our lives, because we put them in together in our decision-making process. Good, bad, and ugly. It is the reality, but as a group, our challenge is to see reality, right? Because of our inherent biases, and things like greed and fear can also blur reality. Our job as a community, and one of the powers of a community, is that we can, if we share enough amongst each other, we're better able to see reality despite our individual biases. And by biases, I don't mean like you're bullish or bearishness, but, more like the greed or fear aspect of what's going on. We don't want to be too fearful. We don't want to be too confident. We want to see reality. We don't want to have confirmation bias, for example. And as a community, we can share and more apt to actually see reality, which is good. I'm telling you, it's good. You don't want to trade on greed or fear. Okay. So anyways, I want to point you to some resources. Tradersway.com is a great broker. I've been working with them for many, many years. I recommend that you check them out. Open up a demo account. I believe they are trustworthy and ethical in their business practices, but just clearly they are an ECN. They don't trade against their clients. And there's a lot of benefits to that. And one of them might just simply be trust. If you go, remember in FX Boot Camp? Well, I ran FX Boot Camp for 20 years, and then I've rebranded it because I think we should branch out. We should get big. We should talk about more than FX. FX is important. I love the flow of cash around the world, very macro. But it also impacts the bond market, the stock market, the real estate market, the commodities market, okay? So on and so forth. So, hey, gold, oil, an apartment building, a bond, USD, Bitcoin, they're all assets, and they do have a relationship with each other. So that's why Investor Bootcamp was created. It's the next step for our community. Okay? So I point you there. By the way, it's $88 a year. You get at least 88, probably closer to 100 hours. And I'm adding to that right now in a new course. So it's ridiculously cheap. Okay? You know what I mean? Ridiculously cheap. But I encourage you to join, and that's why it's so cheap. Oh, speaking about cheap, how about free? Do you want something for free? Go to tradeplans.ai. This is something I own. I created. I didn't create it. I hired a team, but I own all the intellectual property. And all you do is upload a trade plan, and you get instant feedback, a second opinion, another look at what you're thinking about. And from time to time, what I've been doing is going through the trade plans myself. And your trade plan is anonymous, by the way. And the feedback we give you is anonymous. So, but from time to time, I go in and I review the trade plans on YouTube and provide feedback myself. So you get even a third opinion. And, well, that would be something that would be monetizable, right? Like if I went through your trades and gave you feedback, I could charge money for that, right? Well, I spent many, many thousands of dollars building this intellectual property, what we call tradeplans.ai, and there's no monetization whatsoever. There's no ads, there's no email marketing, there's no subscription. Right now, it's basically charity work on my behalf. Which one am I forgetting? Oh, yeah. Got to do QuantBox. Okay. Imagine your trade plans were based on information like this. Not guesswork, not what you think, not what the guru said on the television, not some Reddit knucklehead. Just facts. Imagine your trading setups look like that. $8 trial. Inside your $8 trial, you will get a macroeconomics training course and a statistical analysis training course for $8. Okay? That coffee is good. So what's on your mind? Let's see. Third, I guess I can just end the poll. Thank you for posting to the poll. I appreciate that. Nobody's interested in Aussie. Really? Okay. Interesting. Jim's like, the best deal on the planet. Oh, that'd be significant, huh? Wow, the number one. Yeah. Yeah. All right, so Aussie's way down. Lots of Chinese news, or let's say news from China, this week. So I would suspect that to move. 25% are interested in Swissy. 28% are interested in gold. And WTI 35. So those are all good answers. And that's probably why 10% are not trading Aussie. In a time of geopolitical risk, Swissy should get strong. Gold should get strong and WTI should get strong. I covered this a week ago at the very beginning of the geopolitical crisis in the Middle East. So if you just listened to the Wayne, you were looking in the right direction. And if you are wrong, you can blame it on the Wayne. I think that was a song in the 90s, right? Blame it on the Wayne. Was that Milli Vanilli? Okay. Burned, what is that? Okay, yeah. All right. Let me stretch. If you don't mind, let me stretch. Oh, God, no. Oh, you have to pay money for TradingView? Oh, interesting. Shows you how much I know. All right, so, yeah. So we're looking at hourly. Yen is neutral. Dollar is weak. Great. But Swissy is still strong. Cool. Because I want dollar weakness and I want Swissy strength, which is, they kind of oppose each other, which makes life complicated. But, you know, this is a complicated time. Yeah, it shows you how strong Swissy really is. So nonetheless, Aussie is weak and has made a Lower low, lower high, lower low. So I guess one would stink about a lower high, lower low in the near future. And CAD might be benefiting from a rally in commodities, in particular oil, but there's other things going on in the world besides oil. I can't grab that, so why don't we do it this way? Oh, it's because it was the lower one. So this might be sort of a rebound, if you will. So we got a lot of interesting things going on, a lot of cross currents going on. Tricky. Very tricky. So once again, it's good that we have this community. Burton says, oh, I see what you're saying. TradingView has a deal, 70% off, so that could be possibly the best deal on the planet. Well, I'll counter that. I think I used to charge $1,618 for the training course. And now I charge $88, and I lowered the price during the beginning of COVID when people were locked at home, and I wanted to make sure people weren't freaking out when markets were crashing, and I wanted to be supportive. So I lowered the price, and then I created the day trading group, so I was with people every day. So I think that, I basically I think that was what, 94% discount. So I think I still win. I cut my price by more than 90% because of COVID. Okay? Yeah. And then ultimately, I don't know how much TradingView cares about you, but you guys are friends and family. You know? What's the price for that, huh? I actually worry about you. I care about you. I think about you all the time. You're my sweet baby. Now, that sounds like a joke, but honestly, it's actually true. I worry about you. I think about you. I'm concerned. I want to help. So I offer you my love. Yeah. You were rewatching some of the videos from 2007, and then it was a little... No, that would be wrong. No, that would be wrong. In 2007, FX Bootcamp was $300 a month. Yeah. And there was no training course. Seriously. There was no training course. And it was $300 a month. But anyways, whatever. Let's move on.com, yo. All right, I'm going for it. I'm hoping for. I'm going for. I'm wishing. I'm begging. I'm praying for up this week, and that would be indicative of risk on. And so the current setup that we have in play is this way: 382 predicts a 1618. Yeah, Jim remembers. Yeah, and for many, many, many years, the first decade of FX Bootcamp was, $300. So anyways, I slashed prices, extreme slash prices during the COVID crash, because I went through the 2008 crash, and that's where I learned about what can happen in times of duress. Let me get my drawing tool, if you don't mind. Is it going to pop up the first time? No, of course not. So I have to Control-Alt-Delete. Then I got to go to, and then I got to find it. There it is. Yeah, it's got 2 instances running, even though I haven't even started it. Where did it go? Oh, closed it totally. All right. Hopefully there wasn't child porn there. All right, let's try it again. Get my EpiPen. There we go. Okay, down, 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 up, up, sell, down, 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 up, sell is the logical play here. That's what's logical. Particularly just technical analysis. A pure technician would have sold that high. It's not a good price to sell now. So what we have instead, for those that are bullish, we're at a buying price. So there's the down, 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 up, up, sell, down, 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 up, up. So bears have already sold, but a bull, now this is risky, okay? But a bull is going to interpret this price level as a potential up. So they have this in play. It's a riskier trade because it's counter trend. But they would, in particular, this is daily. So, I mean, how many of you trade less than daily candles? Pretty much everybody, right? So somebody that's not looking that far out is going to see this as a higher high. Even though on a daily it's not a higher high, but you might be looking on an hourly. And on an hourly, it is a higher high. And so anyways, so it's that lack of congruency on time frames. So Richard says this is just a correction wave. I'm not an Elliott wave dude, but you know, it's interesting. The components that go into Elliott wave are the same components that, you know, I learned by observing the market. So I taught myself how to trade, never read an Elliott wave book, but from what I've picked up over the years of like going to conferences and listening to Elliott wave traders, I'm like, yeah, it's Fibonacci. I mean, you can use a wave, like the idea, like, I think the secret sauce to trading is price action. And what you do is when you have a higher high, you buy a higher low, right? By definition, that means there's a trend. In this particular case, there's an uptrend. So you could just do it blindly, buy a dip. You can use Fibonacci where you buy a 3A2, 50%, 618. I'll give you a heads up. I don't believe Fibonacci works. No, you might get all upset. Oh my God, how dare you, Wayne? Well, what I mean is you can do a 382, 50%, which is not actually a fib level, and a 618. Okay? You can do that, and I'll tell you what, I will trade a 33, 50, 66. 1/3, 1/2, 2/3. I bet you all have the same track record as you. Yeah, it's just like, whatever, dude. And don't be a gullible bull. When you're reading in a book and they're like, the shell of a tortoise grows in Fibonacci ratios, and the husk of a pineapple grows in a Fibonacci ratio, and the cherry blossoms, the sea star. I mean, dude, seriously? And therefore, you can see those relationships in the stock market. It's only natural. Like, oh my God. Seriously? Don't believe that. Whatever, dude. The bottom line is you need to know that the market is bullish, and if it pulls back, you're catching it at a discount. There's an intrinsic value. I mean, dude, seriously, just stick to common sense. Okay? Right? So anyways, so I can trade a 33% and do just as well as a 38. So it's not Fibonacci magic. It's not the golden ratio. You're buying a dip, bro. So, but you could eyeball it. You could use price action, which means you're using what used to be resistance is now support. You can use Fibonacci. But here's the thing. If you want it to go up on a smaller time frame, you're probably going to try it. And if you want this to go down, you probably should have already done it. And for everybody else, you probably don't know what's going on, and you're an innocent bystander getting run over by a freight train. But hey, dude, for some reason, you want to walk on the tracks. Okay, so there we go. So bears have already sold, and they're and now it's a bullish chance. And I don't know what's going to happen, but this week we have earnings season. Okay, and earnings are going to be okay. I already talked about this a couple of weeks ago, 3 weeks ago probably, and that's based on my analysis of GDP. And so my analysis of GDP suggests that American companies are just doing fine. Yeah, there's some concerns and stuff, but it's doing fine. Okay. So there's some up, and what is seasonal is up. The other thing to point out, just to keep everyone calm and focused, is that this top is and was predicted. Okay? This bottom is and was predicted. But we don't know the future, but we do know the past. And so that's why these are predicted moves. Now, we don't know exactly when the down will start and when the up will start, but we know, we don't know precisely, but we know generally. Okay? Okay, I always go up this time of year. I always go down that time of year. I always go up this time of year. But every year is different. But every year I'm exactly the same in intent. Okay, I have a strategic plan, but the tactics need to be adjusted as you fight through the fog of war. Okay. Frank says that we might get a higher high today because of Fed speakers and Yellen. Yeah, Yellen is in Europe. And what's his name? Who's speaking today? I think it's the same guy doing two speeches. I'm going from memory here. I don't remember the guy. But one of them. Okay. Hawker? Okay. Now, Greg Anderson, who has many years, decades even, of trading experience, he says the stock market's going to have a tough time rising in the future. I do agree with that. One of the narratives that I have is that the stock market generally is going to be sideways for a few years. Okay? Treading water. Because we got some problems we need to work out. Okay, this is above and beyond geopolitical risk, which is now the threat to the stock market going up. So just the geopolitical risk in of itself is a massive threat to the stock market going up. So that doesn't disprove Greg's opinion. That would agree. It would concede to it. So that's the trick we have now. Now, and on the longer term, we have issues like a maturing economy, slowing immigration, aging population. So this is all demographic. We have high inflation and because of the monetary policy, slower growth. All of that is likely to retard, depress economic growth and activity in the United States. Okay, that's fine. That would all be on Greg's side. So I acknowledge all of that. And I would say maybe despite that, the U.S. is still a powerhouse. And so giving it some leeway, in particular, the advantage that it can just print money. Okay? Maybe it's sideways. You see, like because it's so big, it can prevent the down but can't address the up. Yeah. Oh, you want to at the swing trading meeting tomorrow, Greg? Yeah, Richard, that makes sense, though. Small caps would be a laggard in this type of economy. They can't get loans, and the loans they do get are more expensive. Okay. All right. Beep. You are the one, only you beneath the moon and under the sun. All right, and here's the flip, the role reversal we just talked about. Huh? If it's up, it ain't stuck. You're like, that's not the words. Okay, yeah. So, uh. Frank says, isn't it true wealthy people get special interest rates on loans? Oh, my God, for sure. Okay. Yeah. So you pay more in when you borrow money. Why? Well, you have less income and less assets. Yeah, so you're going to have to pay more. Yeah, for sure. You also pay more taxes because you earn income and not gains. Like you earn a salary. Yeah, you're going to have to pay. Yeah, there's huge advantages to being rich. Sounds silly, but it's true. I'll give you an example. A buddy of mine, when I was still in San Francisco, I'm not doing Forex. It was before that. I was running a startup and doing my consulting business. And I used to work to the wee hours of the night, and the only friends that I could ever have were investment bankers because they also work nights and weekends. And it was funny for my 25th floor apartment where I did a lot of my work, and then later I got a big office. But I had work late in the night, and I remember I can just look out my balcony because I had $1 billion view of San Francisco, but I could see downtown San Francisco, and my buddy was working on the top of that skyscraper, which was like the 80th floor or something. And I'd look, and that my buddy was working. But anyway, so he would tell me stories of being an investment banker, and he was one of these guys where it was his job to fly to Switzerland and go skiing with their clients. Like, what a job. And right? So anyways, but he was telling me like, oh, you'd ski all day. And I'm like, how does that even work? And he's like, oh, well, you gotta like manage and maintain the relationship for the bank. I'm like, what does that even mean? He said, okay, well, we got on this chairlift. We're going to the top of the mountain for another round of sloping. So he's on the chairlift, sitting in the seat right next to the client. And the client says to him, hey, I was just in the Caribbean and I found like a $12 million place I want to buy. So I'm going to withdraw some money. And my buddy says to him, I'll tell you what, we'll give you the interest rate, because the guy obviously can pay in cash. He's like, we'll give you the money at our cost, which is like 1.5%. This is back when interest rates would have been 5 or 6. He's like, we can pick it up prime at 1.5%. So I'll tell you what, instead of you taking money out of the account and buying the property, we will just take care of the property and charge you 1.5%. And you can keep the money in the bank because you're making 10-20% a year in the stock market. And he's like, yeah, that sounds good. And then they get to the top, and they ski off and they're done. And boom, just did a $12 million mortgage. And paying well less. So when mortgages were 5 or 6%, yeah, his client was paying 1.5 or 2. Because that way the bank can keep the money, keep the money in the account. So anyways, everybody's happy. Guy has a $12 million beach house, and he basically gets the money for free. Nice. Richard said this war could take oil to $100 fast. Well, what I said 1 week ago when we were here, that like 150 is what, like 100, that was already in the cards. Kendo says, yeah, Wayne, very true. You used to work at Lehman. Yeah, at the Bros. Oh, Menlo Park. I didn't even know you had one there. That must have been interesting. Really, was it a wealth management side? No, but you broker. No, but you said you worked at the IB division. Interesting. Didn't even know they had one. I'm sorry about that. Yeah, I'm not sure. How big was their West Coast business? It's interesting. The Bros. Okay. Oh, bought by Barclays in 2008. That's interesting. Yeah. Well, the powerhouses in San Francisco really changed. Like I'm talking about the 90s, right? And that was when European banks were just rolling in. So my buddy worked at, I think it was Hamburg and Quist, which was a big but boutique investment bank in San Francisco. Bill Hamburg was the guy. And then I think UBS rolled in, and there was a really big investment banker that was just hired from another firm to work for UBS, and they bought, like they rented like the 80th floor of the Bank of America building and that kind of stuff. I can almost think of the guy's name, a big like rock star name. And they just gobbled up all the young investment bankers. And, this is where like my buddy would have been about 23 years old. And he personally led IPOs. I mean, amazing. Like you're 23 years old and you're the lead on IPOing. So anyways, big, interesting times back then. But I don't remember the Bros, but I don't know. I did at that time hire a big East Coast law firm to represent me because I started doing work in Silicon Alley. But I was basically living in New York and San Francisco at the same time. And so I decided to bring on because, Wilson Sonsini, it was where everyone was going, but they were asking for too much. And there was a couple of other West Coasters that I just passed on. But Mofo was moving into the West Coast, but they were an East Coast company. So anyways, they gave me a better deal. And they were horrible. I ended up firing a law firm. Pretty amazing. Barclays, huh? Yeah, see, I don't even remember Barclays being a player on the West Coast back then. All right. So anyways, enough for nostalgia. But going back to Frank, yeah, it's better to be rich. You're going to pay less taxes. You're going to pay less to borrow money. Just think of it from the bank's point of view. You have perfect credit because you have tons of money and you have no debts. because you don't spend your money, you invest your money. So the debts you have are tied to assets. So you own a lot of assets. These assets pay a lot of income. You always pay people back, and your scale is larger. See, when you take on 50 clients with mediocre credit and you give them loans, the default rate's quite high. But what if you just lent one wealthy person the same amount of money that you would have lent 57 people? So you lend this one person the same amount of money as 57 different loans to somebody that has a huge asset base, huge income to pay for it all, and perfect credit. You're like, pfft. So the scale, because it's so much cheaper to give it to one person, because there's only one person in which you have to solve the asymmetric information challenge, which is in the training courses, by the way, if you don't know what that means. And it's not hard to solve. This guy's filthy, stinking rich and pays everybody back on time. Easy. Okay? So, yeah, smaller borrowers have to pay more. Yeah. For sure. Okay? Cool. Also, when you think of investment bankers and private banks, really, because it's not really IBs, but it's a private banking part of investment banks. And really what's happening here is if you're a commercial bank and you take on a depositor, the only thing you can invest the money in is mortgages or treasuries, which cap out at what, 5% a year, minus your costs, which would be paying your depositors an interest rate, for example, but there's other costs. So there's a spread. Okay. Now think of a private bank inside of an investment bank that's not actually a bank. We're not talking about a bank, commercial bank charter anymore. So what do they do with this money? Well, in the example I gave, they use the money to invest in the stock market now that's making 20% a year. So what they do is say, oh, leave the money there and we'll give you the money for your beach house at our cost, which is nearly free. Because they know they're going to leave that in the market, the stock market, not the bond market that's earning a tiny little yield, but they're making a lot more money. So they're like, dude, the cost of this money is so cheap. So we'll just give you the money for free because now it's the investment bank borrowing the 21 million or whatever I said in the example. And now you leave your cash in the market. You're going to make 20% and it's a carry trade. They're like, don't worry about it. Leave it in the market because you're going to earn 20%. And then the pittance you pay for your mortgage is nothing. Kendo says, yeah, the bounty hunters. I call them the Serbian customer service team. So anyways, gold way up, huh? Way up. Okay. So 1 week ago, on Sunday, I'll remind you, Sunday, 1 week ago, I met with the day trading group and we were right here. And I said, there's only three things you should focus on: buying gold, buying oil, buying Swiss franc. And seriously paying attention to dollar because you don't know, but I'm like, but I want dollar to be weak. So I'm like, cross currents. So focus on gold, oil, and Swiss franc, all of which would appreciate. That's in that circle. Okay, the bottom is basically 1800. Do you guys remember my target? How many people here remember my target? In particular, here on the gap, the Sunday night market gap. Does anybody remember? By the way, this is a good opportunity for you to click the thumbs up button. Wink, wink, nudge, nudge. No, Paulie's close. It's a memorable number, but not because of that. 1930 is a depression. No, but it wasn't 1930. Huh? Really? Nobody remembers. Wow. I remember. 1929. No. 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 I'll give you a hint. It's on the chart. Okay. What does this predict? Remember, I don't guess. What does this predict? Once we gapped up, we knew that that was a bottom. Okay. So Paulie's like 1945 is his. I get the number, but under the rules of engagement of consistency over the last 20 years. Okay. S1 to R1. So what's the number? 1918. Okay. 1 week ago. Actually, just slightly more than 1 week ago. Then I said it again in Forex.Today. I'm pretty sure 1918 for the, as Frank points out, S1 to R1. Okay, that's what I have. And again, I'm trying to remove, when I teach you guys these rules of engagement, I'm trying to take out opinion as much as possible and give you sort of factual consistency. So Paulie says 45. Yeah, I don't disagree with that. I don't. But if you're going to have rules of engagement, they have to be like mostly true most of the time. Okay. No, Jim, I had 17 because or 18. Remember, I was thinking about the First World War, and I was thinking about Gallipoli really in my mind because I'm Australian and all that kind of stuff. So 1918 is what I said. But here's the rule of engagement I'm trying to give to you, and for you to keep. Okay, this is your key takeaway. The repeatable pattern here, which is mostly true most of the time, is S1 to R1. That's how I want you to think. Can it go up higher? Well, if it's fundamental, absolutely it could go higher. It could go way up here. It could go way beyond. We can go to 3,000 if the geopolitical risks get significantly worse, and they can. But using our technical analysis, which you would apply over and over and over and over into all kinds of situations, S1 to R1 is the repeatable pattern. Yeah. And if things get worse geopolitically, you'd probably get a scenario like this. And it just keeps going in an unstoppable fashion. Okay? It's a financial tsunami. People are freaking out and moving to gold. It's logical. I asked you guys on Monday to write it down as a contingency plan to always undertake during a time of geopolitical risk. Once again, Sunday morning, you might remember this because I told it on Monday. Sunday morning, I knew I was going to be out and about in the world, but I also know the markets are going to open, and I had watched all Saturday and Sunday morning the events unfolding in the Middle East. And I'm like, I have to be ready, willing, and able. So anyways, I have to run my life, and I'm out on the road, and I know I'm going to be out on the road at 6 o'clock in the evening on Sunday when the markets open. Okay, the New Zealand Open. So I have my laptop with me, and my butt is firmly planted on a chair in a Starbucks with my laptop open. 3, 2, 1. Ding, 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 ding. Gold, oil, Swiss franc. That's the lesson. That's the lesson you have to walk away with. Not the 5A cross or this, that, or the other thing. The fact that you're ready, willing, and able at market open because you are aware of the geopolitical risks and what to do is so much more important than what moving average you use, what oscillator you use. Do you use price action or do you use Fibonacci? Do you use pivot points? Dude, they're all the same. Who cares? But knowing what to do, when to do, and why you're doing it is more important. Okay? So I want that lesson to be the one that you take away. Okay? Oh, yeah, no, but Paulie, what I'm saying is I'm not disagreeing with you. The issue is sort of pattern and time. Okay? I wouldn't say 45. I know you're using that, but I'm going to lean on, like, I would say 55 instead of 45. Okay? But knowing the general pattern of what mostly works most of the time. You see, Paulie? And then what you do is adapt tactically as you work your way through the fog of war. But you have to understand the right strategy at the right time. And that's going to be things that are mostly right most of the time. And that S1 always predicts R1. What happens after that? Well, you got to make decisions. But you have to know the general plan of attack. Okay? Yeah. Cool. Okay? Okay? That's a bit of a stretch, Richard. You got to be careful. Don't overdo it. Okay, don't overdo that. So before you start doing cross pairs and stuff, don't overdo it. Aussie, technically and fundamentally, is not really that great of a trade. I'll give you an example. So you're saying you might want to short pound Aussie. Okay, I understand the logic. But buying Aussie because gold is going up is too generalized. Too generalized. You're ignoring the state of the economy and the monetary policy and global macroeconomics. So you have too generic of a rule. And so we need to filter it before you end up trading it. And I would say, looking at the Aussie dollar versus everything, it's not a good buy. I would caution you. If you were my client, I'd say, I understand what you're trying to do. And generally, it makes sense, but it probably doesn't make sense now. So I would caution you as your advisor. Okay? And I would suppose I would show you something like this, where the Aussie is weak, and it should be weak. So be very careful. I understand your bearishness on pound. Great. I understand you're watching gold. Great. I understand you're trying to correlate gold with Aussie. Great. But I would not recommend it if I were me. Oh, I am me. Well, then I don't. Good. We might even be able to take this further and just see. I don't know. I don't really trade cross pairs. I'm a macroeconomic trader. But we could do some crosses, and you're interested in pig Aussie. Okay. And analyzing this, QuantBox says, not a good idea. Yeah. Okay. 50% of institutional investors are short the pound. 77% are short the Aussie. Huh. 77% of institutional investors are short the Aussie, and you want to buy it? Now, retail is 2/3 short this pair, but, okay. Taking a look at pound Aussie, we see that retail traders are 40% long, 60% short. We consider this information most useful when a market is at an extreme reading from retail traders. If the retail crowd is 60% or more positioned to one side, we get a +1 or -1. Currently, the pound Aussie gets a reading of 0 in this category. Actually, that shouldn't be correct, huh? I should double check that. That's actually not correct. It should be a -1. Okay. And what does it actually say? Retail, yeah, it says 0. But anyways, remember, if the retail crowd is very long, we look to short and vice versa. So they're very short, which means, if anything, you'd want to be long this, but being long doesn't make any sense based on institutional positioning, and doesn't make a lot of sense economically. There's a slight carry to the upside. I mean, so QuantBox says no target. Fundamentals are mixed. Retail is heavily short. Institutional is flat. Seasonal is long-term slightly up, but short-term mostly down. This is not a good setup. It's just not. It's a gobbledygoo mismatch. So then I go back and I do my own analysis. And like I said, when I compare the Aussie dollar to everything, so I've created my own Aussie dollar index. Right? And I'm like, I understand what you're doing. I don't recommend it in this scenario. Okay? I'm not trying to prove you wrong. I'm trying to save you money. There's a difference, right? I disagree because I love you. Yeah. Anyways. Hung, do I get a thumbs up for that? Come on, click the freaking button. Come on, man. Click the button. Yeah. Hey, my pleasure, man. All right. Well, I'll tell you what. That was a day. If you're in my day trading group, I'll see you at 4. Okay, tomorrow is the swing trading group where we all meet together and do our fundamentals as a group, which is fun. I kind of like the new format. Yeah. Uncle Gregors is going to talk to us about fundies. Is that right, Uncle Gregors? Crazy Uncle Greg? So anyways, look, I'm grateful for what we do here every day. Forex.Today, I honestly believe makes the world a better place. Okay? This is more than a YouTube channel. This is more than me being a YouTube guru. I'm not trying to get views and banner ads and all that kind of stuff. That's not what's in my heart. I share because I care. I want us all to succeed. I still remember how frustrated I was when I became a Forex trader, that all the information about how to do this right was a secret. And I got so mad. And I realized early on when I ran into let's call it stressful times as a Forex trader, that the secret to survival was surrounding myself with like-minded people. And here we are 20-something years later, and I think it was the right decision. My goal was to create a community by just sharing with everybody everything that I learned. Remember, when I started, there were no Forex books. There were no Forex gurus. There were no Forex trading courses. There were no Forex anything. Yeah. I mean, imagine Amazon.com was a startup that most people hadn't even heard of. And the only thing that Amazon sold was books. And when you typed in Forex, it was one book called Forex Made Easy. And that book taught you how to use a MACD. That was the whole book. You didn't even use candlesticks. So you paid $5,000 a year to use a MACD. That book basically sold the course and the tool. Oh, there was also a guy walking around conferences, trading conferences, and he said he invented the Japanese candle. He went to Japan, and he said he did research, and he got all these books in Japanese, and then he brought them to America, and he had them translated, and now you can get the 275,000 different candlestick patterns in his book. And his books only cost $500 to $1,000 for a book. And you're like, what? So that's what it was like when I started. No gurus, no books, no training courses. And I'm here 20-something years later, and I love sharing and with you and learning from you and doing this together. And I don't know if you get that anywhere else, but I think this is special, and I appreciate you on this channel. So peace on earth. May the pips be with you. May our profits be above average. And I hope to see you soon. Maybe consider joining investorbootcamp.com. That's where we can meet either every day or every week. At the very least, you can do the training courses. Okay? But what you'll find is I really want to help, and that's the best way. Either these free training live streams, but your next step in our relationship is for you to go to investorbootcamp.com and start there, because I can roll up my sleeves and work with you at a much higher, much deeper level. So thank you for being you. Have a wonderful day. Cheers.